61 an ounce on January 28th, 2026. And then, in what felt like a single breath, it swung the other way. Not months, not weeks. In 48 hours, the market went from euphoria to a liquidation stampede. And the most unsettling part is not that prices fell, it's that the fall looked engineered by math, not emotion, as if a switch had been flipped inside the plumbing of the future system. For years, the standard story was that silver is too deep, too liquid, too mature to do anything disorderly. They said the age of vertical metals moves was over. They said volatility had been tamed by modern risk systems and diversified flows. 67 during the rout. That kind of movement doesn't happen in a calm market. It happens when leverage is forced to unwind and when the market's internal constraints suddenly matter more than the narrative people repeat on television. Here's where it gets interesting. When a market moves that violently, most people assume everyone sees it at the same time, but markets don't work like that. Institutions see the stress points first because they are the stress points. They know where the margin thresholds sit. They know which portfolios are crowded. They know what happens when a clearinghouse recalibrates risk. And by the time the headlines describe volatility, the real decision has already been made inside risk committees, clearing firms, and the quiet mechanical rules that decide who gets to stay in the game. What I'm about to lay out changes the way you look at the silver tape. Because a silver move toward 100 isn't crazy in the way people mean it. It's crazy only if you assume silver trades like a simple commodity. If you treat it as a hybrid instrument, part industrial input and part monetary pressure valve, then certain triggers can push it into levels that look impossible right up until they print. Welcome to Quiet Alpha, where we decode what matters before its headlines. If you like calm, data-driven breakdowns of markets that most people only notice after the move is over, you'll feel at home here. Think of subscribing the way you'd listen to that wise elder who doesn't speak often, but when they do, it's worth hearing. And drop a comment with where you're watching from, because this story is global, even when it looks like it's just a chart. Now let's reconstruct what happened, because the details matter. Silver didn't just drift higher, it accelerated. 61 on January 28th, 2026 implies a market already under tension, where marginal buying can lift price sharply because supply at the offer is thin or cautious. In a normal environment, you'd expect a climb like that to invite profit-taking, sure, but not an air pocket, not a sudden collapse that feels like gravity doubled. The central mystery is this. How can a market spike to that level and then, within days, show a violent intraday plunge, while the long-term physical reality of silver doesn't instantly change? Mines don't triple output overnight. Fabricators don't stop using silver because a screen price flickered. Jewelry demand doesn't disappear in an afternoon, yet the price does. That contradiction is the clue. It tells you you're not watching a simple supply and demand spot market. You're watching a leveraged paper structure that can expand and contract faster than the physical world can react. If you've been around precious metals long enough, you've seen this movie before. The script is always the same. A surge draws in momentum and leverage. Then the system tightens the screws through margin, liquidity, and positioning, and the unwind becomes self-feeding. In 1980, silver became a symbol of panic and speculation, driven in part by concentrated players in a frenzy that ended with a brutal reversal when the rules and the credit spigot changed. The result was not just a price drop, but a psychological scar that taught an entire generation to fear metals volatility. Fast forward to 2011. Silver climbed toward 50 an ounce, and then the market was hit by a sequence of margin hikes and forced deleveraging. The selling was not purely discretionary, it was mechanical. It wasn't simply that people changed their minds, it was that they were required to post more collateral quickly or exit. The result was a sharp fall that looked irrational if you only watched demand narratives, but made perfect sense if you watched the structure. Then look at March 2020. In a broader liquidity crisis, many markets experienced violent dislocations as cash became king. Precious metals didn't escape. In some places, paper prices fell, even as physical premiums rose. That gap was the market telling you, in plain language, that the screen was reacting to forced selling while real-world metal was reacting to scarcity and logistics. Silver was pulled into that conversation, and again the story ended with a reminder. When leverage and crowding collide with the rules of clearing, the rules win. So when we see a 2026 move that rockets toward triple digits and then snaps back, we should not treat it as unique. We should treat it as the pattern resurfacing. A rapid ascent is not just a price event, it's a stress test. It tests who is short, who is long, who is hedged, and who is borrowing the market's confidence. Now, let's talk about the players, because the tape tells you more when you know who can actually move it. One of the most striking details reported around this episode is the role of a Chinese brokerage, Zhongkai Futures. The reported positioning was not a small tactical hedge, $5 billion in notional value. And, according to the same reporting, the profits from the rout exceeded $500 million. Pause and absorb what that means. A short of that magnitude is not a casual opinion. It's a deliberate stance that requires funding, margin capacity, and a risk framework that can survive volatility. It also implies access to liquidity, to timing, to an understanding of where the weak hands sit. At the same time, the broader futures ecosystem provides context. The CFTC's futures-only data showed open interest around 156,637 contracts in COMEX silver, with each contract representing 5,000 ounces. That open interest is a reminder that the paper footprint is massive. It's not one-to-one with physical metal. It is layered with hedges, spreads, and leverage. In other words, a large portion of silver exposure is an accounting entry that can be expanded or compressed rapidly. Then you have the physical anchor, $4 billion at the time of the report. That's not a small pile of metal. But it's also not infinite, and it's not all equally available. Some of it is allocated, some of it is tied up, some of it supports ETFs and industrial flows. And most importantly, it doesn't teleport to meet a sudden delivery demand in another region. This is the part no one is discussing. The silver market is simultaneously huge and fragile. Huge in notional paper terms, fragile in deliverable physical terms. When paper demand surges, it can lift price quickly. When paper leverage is forced to unwind, it can smash price quickly. But the physical system lags. It moves slower, like a ship turning. And when the screen price diverges too far from physical reality, the divergence becomes the trigger for the next phase. So what exactly is the dislocation here? It's the collision of three speeds. First, the speed of speculative futures positioning, which can change in minutes. Second, the speed of institutional risk systems, which can change in hours or days through margin, requirements, and limits. Third, the speed of physical metal, which changes over weeks and months through refinery throughput, shipping, and industrial demand cycles. When those speeds line up, markets feel normal. When they diverge, you get chaos. Silver in early 2026 looked like a case study in diverging speeds. Price sprinted upward, suggesting tightness or panic demand. Then the risk system reacted, and the unwind began. Meanwhile, the physical world did not suddenly become awash in new silver. The extra supply was paper longs being forced to sell. Imagine a crowded theater where the aisles are narrow. Everyone can sit calmly as long as no one moves too quickly. But if someone yells, "Fire," the crowd surges, and suddenly the same theater becomes a bottleneck. The problem is not that the building changed. The problem is that the flow changed. Futures markets are like that theater. When leverage builds, the exit becomes narrow because everyone needs liquidity at the same time. Here's how the mechanism works in plain terms. When a contract price rises, longs make money on paper. That attracts more participants, often using leverage, because futures require only a fraction of the notional as margin. As volatility increases, clearinghouses and brokers recalculate risk. They raise initial and maintenance margins, and they may tighten intraday controls. A trader who was comfortably leveraged yesterday can become under-margined today without doing anything wrong. They receive a call. Add collateral now or reduce exposure now. Now multiply that across thousands of accounts. Some can post, many cannot, or choose not to. They sell. Selling pushes price down. Falling price increases volatility, which can justify further margin adjustments. That leads to more calls, more selling, and a feedback loop. In extreme cases, it becomes a forced auction, not a rational market. Now, let me slow this down even further because the phrase forced selling sounds abstract until you see how it plays out on a desk. A futures contract is not like buying a bar and putting it in a drawer. It's a promise mark to market every day. When silver is rising, that daily mark feels like a tailwind. When silver turns, the same mechanism becomes a trapdoor. The account doesn't just lose in theory, it must settle losses in cash on a schedule with no sympathy for the person holding it. That schedule is where the clock speed difference becomes deadly. The industrial buyer who needs silver for production isn't bidding in that window. They're planning procurement over quarters, so the market can fall through levels that make no sense to the end user, simply because the end user is not the marginal participant in that moment. This is also why paper versus physical is not a slogan. It's a map of two different ecosystems. Paper silver is mostly a risk transfer network. Miners hedge revenue, manufacturers hedge input costs, funds speculate, banks intermediate. Most of those flows can be netted, offset, rolled, and closed with a click. Physical silver is a logistics network. Bars must meet a specification. They sit in specific vaults. They move through refineries. They travel on ships and trucks. The network is real, slow, and constrained by time and capacity. When the paper ecosystem panics, it can create the illusion of abundance. Prices fall, and it looks like supply has arrived. But nothing has arrived. What has arrived is an urgent need for cash from leveraged longs. In the physical ecosystem, the opposite can be true at the same time. Buyers may quietly step in, Refiners may be backlogged, and premiums may stay firm because the actual metal is not suddenly cheaper to obtain at scale. One of the clearest tells during these episodes is the behavior around delivery. Most futures contracts never go to delivery. They're closed or rolled. But when stress rises, attention shifts to who can actually perform. If more participants want to stand for delivery, or if fewer participants are willing to issue, metal, the system feels it. The market doesn't need a full-blown default to reprice. It only needs the perception that deliverable supply is tight relative to open interest and potential demand. Now zoom back to why 100 becomes possible. Silver is a relatively small market compared with the oceans of capital that can move through derivatives. That's not an opinion, it's a scale mismatch. Even the London Vault number, tens of billions in value, is tiny compared with the balance sheets and flow capacity of global funds. When capital wants exposure, it can overwhelm available liquidity. When capital wants out, it can overwhelm bids. That's why silver behaves like a calm industrial metal for long stretches, then suddenly behaves like a monetary asset in a storm. There's also a supply nuance most people miss. Silver supply is often a byproduct of other mining, like copper, lead, and zinc. That means higher silver prices do not automatically produce a quick surge in primary silver output. If copper output is flat, silver byproduct can be flat. Recycling can respond, but it responds with lags. So when demand accelerates, inventories take the hit first, and price adjusts to ration demand and incentivize flows. This is the part that separates a one-day spike from a multi-month repricing. After liquidation, the market either stabilizes because the leverage is gone, or it stabilizes only briefly because the underlying tightness remains. If the underlying tightness remains, every dip becomes an invitation for physical buyers and long-term holders, and the paper market eventually has to reconcile with that. When it does, price can return to prior highs faster than people expect, because the base has been reset. Against that backdrop, concentrated positioning matters. A large short position, properly funded, can withstand the initial surge and then benefit from the unwind if it coincides with tightening margin conditions. This does not require conspiracy, it requires competence and capital. It requires being positioned before the turn, not after. The market rewards the participant who understands the rules of the game, not the participant who is right in theory. Now, why would silver ever move toward 100 again after such a crash? Because the same mechanism that can smash price can also propel it when the constraints shift. There are a few triggers that historically produce upside regime changes in silver. One trigger is renewed wave of monetary stress. Silver is sensitive to real rates and the purchasing power narrative, even though it is also industrial. When confidence in currency stability wobbles, precious metals become a pressure valve. Another trigger is an industrial demand inflection, particularly if it collides with supply constraints. Silver is used in electronics, solar applications, and other technologies. If demand grows faster than supply expansion, inventories become more important than price commentary. A third trigger is a breakdown in the paper-to-physical translation mechanism. If too many participants demand physical delivery or secure allocation at once, the price for real metal can decouple from the paper price. That doesn't automatically mean an overnight moonshot, but it does mean the reference price can re-rate as the system tries to coax metal out of strong hands. And a fourth trigger, which is often underestimated, is regulatory or policy-driven change in the futures ecosystem itself. Margin rules, position limits, contract terms, and the behavior of clearing members can alter the leverage capacity of the market. When leverage capacity expands, price can trend higher with less friction. When it contracts, price can crash. But if contraction forces weak longs out and leaves a tighter base, the next rally can be more durable because the market has been cleaned of positions that were destined to be forced sellers. So the question isn't whether silver can mathematically print 100. We've just watched it print above that level, even if briefly. The question is, what conditions would make that level sustainable, not just a spike? Sustainability requires a different balance, less fragile leverage, stronger physical demand, and a market structure that cannot easily manufacture supply through paper selling. Let's connect that to the evidence. The open interest figure around 156,637 contracts tells you the paper market is deep enough to absorb massive speculative flows, but also deep enough to hide concentration. You can have a seemingly liquid market that is actually brittle because the liquidity is conditional. It exists as long as volatility stays within a band. When volatility breaks the band, liquidity evaporates. That's exactly when prices gap, and people call it crazy, even though it's the expected output of the system's design. The London Vault figure, 27,818 tons, tells you physical silver exists at scale, but it is not a free-floating pool. It's a balance sheet item. It supports obligations. If demand shifts from exposure to specific bars in a specific place with specific title, then the functional supply shrinks. This is why physical premiums can rise even when screen prices fall. The screen is reflecting forced liquidation. The real market is reflecting availability. Now, what does the Jonkai Futures detail tell you? It tells you that certain institutions are willing to carry size that most participants can't imagine. They can be right, for reasons that are structural, not narrative. A 484-ton equivalent short is not about a gut feel. It's about anticipating the stress points. If their profits exceeded 500 million, that is a clue that the unwind was large enough to monetize, not just a small pullback. It suggests that leverage had built to a point where a downdraft could become a cascade. So what are the catalysts to watch going forward? The things that would trigger a return to 100 in a way that isn't just a flash on the tape? Historically, the big catalysts are not a single headline. They're a combination of indicators that tighten the net. Watch the curve. When near-term contracts trade at a premium to later contracts, it signals demand for immediacy, often associated with physical tightness. Watch borrowing costs and the ease of sourcing large bars, because stress shows up there before it shows up in popular commentary. Watch reported inventory changes, especially in the categories that are actually deliverable, and watch positioning data for signs of extreme net short or net long concentration, because the most violent moves tend to happen when one side is too crowded to exit gracefully. Also watch policy behavior. When regulators or exchanges change margin requirements, contract terms, or reporting thresholds, it's rarely random. Those changes often coincide with volatility regimes. They can either dampen price by choking leverage, or, paradoxically, set up the next surge by clearing out fragile positions and allowing stronger hands to rebuild exposure. Now, let's lay out 3 scenarios, not as predictions, but as historical pathways. In a conservative scenario, volatility remains elevated, but the market digests the move. Silver trades in a wide range as leverage resets. The trigger toward higher levels would be a slow grind of demand, outpacing supply with occasional spikes, but no sustained breakout unless monetary conditions worsen. In a moderate scenario, the paper-to-physical gap widens. Physical premiums remain firm, inventories tighten, and the futures curve begins signaling stress. In that environment, a push toward 100 becomes plausible if a new wave of demand arrives while the market's ability to provide paper liquidity is constrained. The move would not need hysteria, it would need persistent tightness. In an aggressive scenario, you see a true structural squeeze where physical availability becomes the limiting factor. That could be driven by a surge in industrial offtake, a rush for allocation, or a breakdown in trust in paper claims. Historically, when trust breaks, markets reprice quickly because the price must rise to ration demand and draw supply out. That's how impossible levels become prints on a screen. The divide, and this is the part that matters most, is not between smart people and less smart people. It's between those who watch stories and those who watch structure. Stories are loud, structure is quiet. Structure shows up in margin tables and open interest, in vault flows, in the curve, and the cost of carrying risk. The wealth gap in markets is often an information gap. Institutions move first because they can see and influence the constraints. Retail moves last because it sees the headline after the move has already been priced. So when someone says, silver to 100 isn't crazy, the responsible way to hear that is not as a promise. It's as a statement about triggers. If leverage rebuilds in the same place, if physical tightness collides with monetary stress, and if the market's risk plumbing forces a repricing, then history suggests higher levels are not fantasy. They are simply what the mechanism produces. This is quiet alpha, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. And remember, the question isn't whether volatility returns. The question is whether the signals are understood before the crowd realizes the game has changed.